Hi, my name is Jade, co-founder of Legendary Real Estate Services, and we are at a pivotal point, not just in time frame for being mid-year, but there's some new things going on with the economy that is literally pushing us right at the cliff of, are we going to be in a recession? Are we not going to be in a recession? And changes that are going to make a difference in the housing market, not just on a national level, but on a local level as well. So let's dive in. The biggest news is that after 10 consecutive rate hikes since they started in March of last year, the feds have decided to finally keep rates constant. Now, they did slow earlier in the year when we had those banking failures and they didn't hike the rates as much. So now they're saying that we are approaching where they want to be, and it's just sort of a common sense to keep it constant. My 2 cents on common sense is maybe not hold rates so low that the market accelerates and overheats so fast that now you have to yank the reins so hard that it causes a bunch of bank failures. But you know what? That's just me. What do I know? What does this mean for the real estate markets? Well, if rates stabilize or even hopefully dip to about 4 to 5%, that might be enough to spur inventory activity and end that lock-in effect that we have, where homeowners who have sub 4% mortgage rates now feel comfortable with moving on with their life plans and potentially selling their home and listing it on the market. So hopefully that spurs our industry, because right now there's really no incentives for sellers to sell unless they absolutely have to. If you happen to be one of those sellers that absolutely must move, call me. I can help. In terms of the overall economy, though, the question really has to be asked, is it going to be enough, or is it going to be too little too late? Because right now, consumer spending is about 2/3 of the US economy. And so if consumer spending goes down, so does our economy. And right now, what's been propping up consumer spending is credit and excess savings, which, as you can see from this graph, it's whittling out. So the bottom line is that consumers are running out of fuel, and really it's setting the table for an economic slowdown, because wages, they're not keeping up with the pace of inflation, and consumers have tapped into their credit cards, their equity, and they're reaching their natural limits. And also it's going to cause, as you can see, the delinquencies to go up. So we're heading into negative territory where people are having diminished savings and dipping into credit and potentially seeing more delinquencies. So what again does this have to do with real estate? Well, despite the shortage and affordability issues that we do have, real estate is really the gem of the economy, and it's carrying the market through. Why? Because with inventory being so low and construction being low, demand continues to be strong. The simple mechanics of it is that when supply goes down, what goes up? Prices. Home builders, they're still recovering from that gut punch of that 2008 housing crisis that pretty much wiped many of them across the board. So what's happened across the nation is that construction really has picked up in the commercial apartment level. So we have a lot of new inventory that came up in the West Coast, in the southern states, in the East Coast, and a lot of appreciation, as you probably have followed the news, has occurred. They've overappreciated in those areas. They've got too much inventory of residential commercial units in those areas. So they went up very fast, and now they're seeing the pain. Whereas here in the Midwest, we didn't have that boom in construction. Maybe in some areas like Chicago, they did, but not so much in the more rural areas like how we are in the Geneva Lakes area. So as you can see from this graph, the Midwest, it's now the most affordable part of the United States, but we're steadily and strongly appreciating across the board. Speaking of new construction, here in Wisconsin, while I'm still waiting for the Wisconsin Builders Association to update their website, here in Walworth and Kenosha County, we are woefully behind in terms of building permits. Racine County is up, but we still are not up in terms of first quarter of this year as compared to first quarter of last year. So what does that mean? That means new construction, we're not going to see a lot of that coming online for at least another year. So that puts us at midsummer of 2024, barring no issues with supply or labor. And if hypothetically they get started this month. The good news is that the overall national home builders sentiment is going up. This sentiment takes into consideration sales conditions, sales expectations, as well as buyer demand and traffic. All three are looking up, and it's hopefully in an upward trend. So we're going to want to watch this. And if this continues to go up, we may see more builders starting to wade into the game, and especially here in Southeast Wisconsin as rates stabilize. So diving in now to supply, what that looks like in the Southeast Wisconsin, Geneva Lakes area. As you can see, the number of listings are turning up and moving up, which is good. And it's also expected for this time of the year, which is more ideal to moving rather than winter or sub-zero conditions. That, of course, has led to a steady rise in the months of inventory. As you can see, we're at 2.31 months of inventory, so we're steadily climbing. However, we're still very much entrenched into a seller's market. Unless it comes up to about 4%, that's when we're about a balanced market. When we start approaching 6 months of inventory, that's when home prices here in our area are going to start softening. So right now, we're looking good. We're sitting pretty. We're going to keep watching this as well. Along with our shortage issues, strong demand is what's also keeping up our real estate market. The lower the days on market, the hotter the market is. Right now, we're at about 39.8. Sub 40 days on market is almost back to the pandemic and post-pandemic levels. This bodes well for home price appreciation in our area, but not so much for affordability for those looking to buy, especially first-time home buyers. These issues, coupled with high interest rates and banks tightening their credit standards even prior to the banking failures, are why we saw the share of buyers who are winning to be all cash offers on the rise. As you can see, it's at a 9-year high. So what does that mean? If you want to win an offer and you're competing against multiple offers and you can't do an all cash offer, you're going to want to have a very strong down payment. This sold to list ratio graph, this is the big one for sellers, because if it's above 100%, that means the home sold for more than asking price. If it's sold for less than asking price, obviously it's going to be below 100%. And right now it's at 97%, which is actually quite unusual, especially with demand where it is. Yes, we have a little bit more rising inventory, but it's nowhere near what it was in previous years. I think this is an anomaly. We are going to want to wait and see what the trend is. Again, it takes about 3 months to show a trend. I think this is going to turn around, and if it doesn't, that's going to warrant some further investigation for sure. Another reason why I think that data point from that previous graph is a bit of an anomaly is that it is at odds with the national data collected by Redfin, which shows that seller concessions and rate cuts were actually down in April. They were up over the winter time frame when there were less buyers in the market. So it was creating sort of an artificial balanced market. Realtors were heavily cutting or offering creative solutions, but that is going on the down. So again, that previous graph sort of bucks what we're seeing boots on ground and at the national level. But again, we'll keep watching. We'll see what happens. One of the reasons why I'm not so worried just yet is because of this graph right here, the U.S. properties with foreclosure filings. As you can see, not too long ago, we were at all-time historic lows. Yes, it's a little bit on the rise, but it's leveled out, and this is going to remain that way. It's going to remain in check because lenders, they have been tightening, and as they tighten their standards, that's going to make sure that they're only lending to people who can afford it. Where we might start seeing trouble is people who bought really at the height of the market, and if they maybe unfortunately lose their jobs, or if inflation continues to be high and interest rates continue to be high and they dip into their savings, they go negative and they start relying more heavily on credit, then we might start seeing these foreclosure filings go up. But even if they do, we still have a long way to go to be anywhere near where it was at during the 2008 housing crisis. What does this mean for you potential sellers? Well, if you want top dollar, this is still very much a good market to get that in. Now, if you don't have a place to move yet, definitely talk to your realtor, because we are having, as I've been saying, inventory issues. So you're going to want to have a place to go to before you sell. Now, if it's in your budget, you're going to want to spend time and money to take care of some of those mechanical and cosmetic repairs. As you can see from this graph, the biggest deal breakers at open houses are disrepair of those major mechanical appliances such as HVAC or plumbing, cosmetic issues that are easy to do, and those dated features. Now, though, before you go out and spend a bunch of money on rehabilitating parts of your home, definitely give us a call, because what we'll do is we'll do a preview and we'll show you different areas that are going to give you the biggest bang for your buck, because first impressions, they're going to go a long way. Now, if your home is sitting on the market for longer than 14 days with very little showing activity, especially with demand where it is right now, something is definitely wrong, and you're going to want to speak with your realtor. If you're working with us, we're already speaking with you, or likely we've bypassed those issues completely. I'm just saying. What does this mean for buyers now? Now, if you're financing, get pre-approved ASAP before you go and see your home. And here's a tip, something that I'm starting to see a trend: rate shop before you make an offer, not after. So if you don't like your rate and then you get under contract and then you go shop for rates, that actually is going to cause a lot of problems in the closing process. Ask me how I know. So let's not do that. Now, if you see a property that you really like, don't wait for the weekend to see it. Let us know. What we'll do is we'll go and preview the home. We'll do a live video so you can see different areas of it, ask questions, and then maybe we can get the property under contract if it's a property that you really love. Now, as rates stabilize, expect to see more competition from buyers as they start trickling back into the market. And when that happens, that sales to list price ratio is definitely going to come back up. Now, don't expect a wave of foreclosures. As delinquencies in credit rise, we may see a few sellers here and there who bought at the top of the market in trouble, but there's not going to be a lot of those. So don't hold your breath. Bottom line, if the feds hold the fund rate where it's at constant, or even drop it just a tad bit, we may just see that soft landing that they're hoping for, and we'll definitely see a shift in the economy for the better, with the exception of inventory and affordability. However, with the trickle-down effect of stable rates, home building activity might be on the rise, which would bode well for that availability issue. If there is still going to be an economic recession at the end of the year, it's nothing like we saw in the 2008 housing crisis. It'll probably last a couple of quarters, and home prices, they might see a correction, but they're definitely not going to see that drop or fall off the cliff again like in the 2008 housing crisis. So I've covered a lot of material. If you have any questions, I love questions. Go ahead and reach out. There's my contact information. Definitely subscribe to our YouTube channel and like us on Facebook. Until then, thanks for stopping by.